So welcome to this amazing revision session on CA Final Financial Reporting, where I'm going to revise the one and only Ind AS 19, and that is employee benefits only exclusively for you guys, right? So if you're watching this session on YouTube, do remember this is 100% English revision only for you, my lovely friends. But before watching, do subscribe to this channel, and also if you like it, do like the video as well. Okay, so now we are starting with the revision of employee benefits. Do remember three things. First, it is 100% English revision. Second, in this revision video, we are going to revise two things. One is the concept, and then we will also revise the questions as well. Oh my god, sir, both of them will be covered in a single video. Yes. So right, if you have studied Ind AS 19 before, this video is going to be very much helpful for you. Apart from this, I am going to upload this board notes on my Telegram channel, so you can download, you can join the Telegram channel and download this notes from there. Apart from that, if any of your friends you would like to recommend my lectures, so they are available on bbvirtuals.com, so that you can recommend it to them. Okay, so on that note, let's start the revision in 3, 2, 1 and go. First of all, name of the index is Ind AS 19 employee benefits. Okay, so in employee benefits, first point is scope. Now in scope, if you refer, it is a very basic point. First of all, which kind of employee benefits are not covered. So if any kind of employee benefits is in the nature of share-based payment, it has a separate index, not covered here. Apart from this, reporting by employee benefit plans. For example, when company contributes the amount of PF in the government PF fund, the accounting done by the PF fund is not covered here. The accounting done by the company is covered here. Okay, so this is the scope. Next point is employee benefits. What is the meaning of employee benefits? Now employee benefits can be of four types. One is short-term employee benefits, next is post-employment benefits, then it is other long-term benefits, and then it is termination benefits. Each of them we will revise it separately. First, we will talk about short-term employee benefits. So if you see my notes, what is the meaning of short-term employee benefits? Any employee benefits which is expected to be settled before 12 months from the end of reporting period. So let's say the employee gives the service today, and if the company is going to make the payment within 12 months from the date of employee giving the service, so that is going to be a short-term employee benefit plan. Okay, now generally what all things are covered under short-term employee benefits. So I have made a good summary in the notes, so you should refer the notes rather than a textbook. So what was there? First, it was salary wages, then it was bonus sharing plan, and it was leave compensation. We will revise each of them one by one. First is salary wages. If the company pays the salary immediately, what is the entry? Salary to cash bank. Achha. What if salary is accrued but not yet paid? Then what is the entry? Then company, because it has accrued, company books an expense, but because it is yet to be paid, it will book an outstanding salary, that is a payable. So it will say employee benefit expense to outstanding salary. Next, when it is later on paid, you will reverse the payable and credit the cash bank. Achha. What if the salary is paid in advance? In that case, you will book a prepaid expense. So you will say prepaid expense account debit to cash bank. Because it has not accrued, you will book a asset and you will credit cash bank. Once it accrues, reverse the asset and book the expense. Simple. And one more thing, if you have paid a salary to any employee who is involved in the construction of an asset, in that case, that salary is not transferred to profit and loss, it is capitalized. Okay, this was the first part, that is salary wages, short-term employee benefits. Next part, bonus sharing plan. Now what is the meaning of bonus sharing plan? Sometimes the company, so sometimes and company get mixed. So sometimes the company, what the company does is, they give a profit target to an employee, and they tell them that if they are able to achieve that profit target, they will give a bonus on that target. So this is known as bonus sharing plan. So now let's say, for instance, an employee is given a target in the year 11-12 to achieve a bonus target, to achieve a profit target, that so that he can get a bonus. So now what the company does is, it is giving the bonus on this profit, on this year's profit, but the payment is going to be made in the next year. In this case, do remember, apply the normal accounting concept. You will book the bonus expense when it has accrued. So it has accrued in the year 11-12 only, right? So company books an expense, and because it will pay in the next year, it will book an expense to payable. And once the company makes the payment, it will say payable to cash bank. Okay, do remember 2 points. First, if the question mentions any expectation or estimates, for example, the company might say we will give 2% bonus, but if the company feels that the ideal payment will happen at only 1.5%, so do consider that estimate given in the question. First thing. Second thing, this bonus is not a distribution of dividend. Okay, why? Dividend is given to the shareholder in the capacity as shareholder. This bonus we are giving to employees because they have met some target in employment. So this is not bonus. Just because you are giving something out of profit, that doesn't mean it is dividend. This is not dividend. Okay, just because you are giving something out of a profit, it is not dividend. Do remember. Okay, next part, leave compensation. I feel in short term employee benefit, this is the most important part. Do remember what is the meaning of this. Leave compensation means every employee earns certain number of leaves in the current year. Okay, so these leaves can be of two types. One is accumulating, one is non-accumulating. What is the meaning of accumulating? If you have any leaves which you did not utilize in the current year, you can carry forward to the next year. What is the meaning of non-accumulating? It means if you have any leaves which you earned in the current year and you did not utilize, you cannot carry forward it to the next year. Carry forward is not permitted here. So if you have any non-accumulating leaves, if you use it in the current year, very good. If you did not use it, it will lapse. So there is no accounting treatment to be done here. What about accumulating leaves? If you have any accumulating leaves, that means it can be carry forwarded. So let's say, for example, in the current year, you had been given 40 leaves. Out of that, you only utilized 10 leaves. So in current year, how much leave balance do you have? 30. Now these 30 leaves in the next year, either it can be encashed, which is known as vesting, or in the next year, it cannot be encashed, but in the next year, you can avail extra leaves, which is non-vesting. So either you can encash the leaves or you can use extra leaves in the next year. Okay. In both these cases, do remember one thing. Company books the expense when the employee has earned the leave. So for example, for this 30 days in the next year, either the company will give extra money or company will give extra leaves. But when did the employee earn these leaves? It earned these leaves in the current year. So for these leaves, company books an expense and payable. So company says leave compensation expense to payable or provision for leave compensation. Why? Because can I say even if the employee might encash it in the next year, but employee has earned it in the current year now. So matching concept, when the employee earns it, that period's expense is it for the company. So company's expense is for the current year and not for the next year. Do remember. Now I had given example also. If it is a vesting case, so I took one example where let's say employee earned 30 days in the current year. Now in the next year, if it encashes it, so in the current year, how will you pass the entry? He will get the full salary for the current year, and in addition, company will book a leave compensation expense to payable. In the next year, let's say if he wishes to encash it, this provision will get reversed in the next year and company will have to make an extra payment. First, if it is vesting means encashable. So in encashable, employee gets extra money over and above his normal salary. Achha. What if it is a non-vesting? That means in next year he cannot encash it, he can take extra leaves. So do remember, in the current year, company books the salary and the leave expense and payable. In the next year, whatever payment the employee gets, he is getting this full payment because he might have some extra leaves. So first reverse the provision and then book the salary. So the difference between vesting and non-vesting is, in vesting, employee gets extra money. In non-vesting, the employee does not get extra money. He gets only salary. The difference is, even if he avails extra leaves, his salary won't be deducted. So that is why first reverse the provision and then book the salary expense. Of course, the logic we already discussed in the class. I'm just focusing on revision here. Okay. So this was leave compensation. Then you can do illustration number 2 and 3 of our notes, which is not LDR, but a very simple question which you can do. Okay. So just practice that question at home. Okay. Then we come towards post-employment benefits. Now, what is the meaning of, if you can see, we have discussed short-term employee benefits. Then in our notes, we come to post-employment benefits. Now, what is the meaning of post-employment benefits? These are nothing but retirement benefits. That means any benefits which the company will pay to the employee on their retirement. That is known as post-employment benefits. Now, these can be of two types. One is defined contribution plan. Okay, and one is defined benefit plan. Now, what is the meaning of both these plans? I have explained here. Defined contribution plan means, let's say for example, best example is PF, Provident Fund, where what happens here is company deposits some money every year in this fund, and when the employee retires, this fund will pay off the employee. Now, why is this named defined contribution plan? Because the company's obligation is over when it deposits the fund in PF fund. When it deposits the money in PF fund, company's obligation is over. Why obligation is over? Because when the employee retires, employee will not reach out to the company for the payment. Employee will reach out to the PF fund for the payment, right? So here company makes a specific contribution to the fund and company's obligation is over after making that contribution. Okay, so how to account for this defined contribution plan? Acha, one more thing. In defined contribution plan, the actuarial risk and investment risk will fall on the employee. What is the meaning of this risk? The risk that if, let's say for example, this fund goes bankrupt, who will have to bear the loss? Employee will have to bear the loss. Why? If this fund goes bankrupt and if this fund is not able to give the money to employee cannot reach out to the company again for the money. Company will say, we had deposited the money in fund, now you will have to ask from the fund only. If this fund is bankrupt, your money is gone. So the risk falls on the employee. That is known as actuarial risk and investment risk. The meaning of both these risks separately has been given in the notes here. Okay, do remember. Now, how to account for this? So I have taken one example, basic example, PF. Let's say every year a company contributes 80,000 in PF. Okay, so if it has accrued in the current year, when the payment accrues, company will pass the entry expense to cash bank, provided it has been paid. What if it has not been paid? So company will say, just see when the payment is due. Let's say the expense accrued today, but the payment is due after 15 days. So what will you do? In the current year, you will book the expense to payable. And when you pay it, you will say payable reverse to cash bank. Normal logic. But the main part comes here. When it accrues in the current year, but it is payable after 12 months. It is due after 12 months. Then what to do? In case of PF in real life, it is not applicable, but taken a hypothetical situation here. So let's say if any payment accrues today, but it is paid after 1 year. So if accrued on 31st March 12, but paid on 1st April 13, after 1 year. Now what to do? So in that case, the logic of present value will come into picture. So you will book the expense at present value in that case. So you will say PF expense to PF payable. You will book it at present value. And then what to do? Don't make the payment directly. Whenever you book anything at present value, at the year end, you will also unwind it. So after 1 year, first unwind the interest. How will you unwind it? Interest expense to PF payable. You will unwind the liability and then you will make the payment. Do remember, when you unwind, normally interest goes in finance cost. This is the only interest which will be transferred to employee benefit expense. Okay, so do remember this concept as well. Okay, so this was defined contribution plan. The obligation is over as soon as the contribution is done. Then we come on towards the defined benefit plan. From exam point of view, this is the most important part. Okay, defined benefit plan. Now what is the meaning of this? Let's take one example. Let's say company has to give gratuity benefit. Have you heard about gratuity? Yes sir. So here what the company will do, company will keep on saving some fund in a own fund. Company will create a own fund, not like a government fund PF, but company will keep on saving the money in some fund. And when the employee retires, it is not the fund's responsibility to give the money to employee. It will be company's responsibility to provide the benefit to the employee. That means employee will reach out to the company on retirement for the gratuity money. Unlike here, where the employee was reaching out to the PF fund for the money. So here, the liability of providing the benefit to the employee falls on the company. That means if this fund goes bankrupt, employee can hold the company liable and can ask for the money. That is why defined benefit plan. Here, the liability to provide the benefit lies on the company. Okay, so here we can say the actuarial risk and investment risk is on the company. Why it is on the company? Because if the fund goes bankrupt, employee can reach out to the company. It is the company's responsibility to make the payment to the employee on retirement year. Okay, do remember that. Okay, now how to account for this? So for this, in case you remember, we had so many terms. The accounting under defined benefit plan is done under a method known as projected unit credit method, PUCM. So we have so many methods. We have so many terms, sorry. So how to remember these terms? So for this, we had taken an example. I will also revise that example again so that you are familiar with the terms. Okay, come very quickly. We will revise. First, what was the example? So let's say there is a company XYZ Limited who hired Mr. Aakash for salary of 10 lakhs per annum. This employee is entitled to a gratuity at 1% of final drawn salary into number of years of service. Okay. Now, final drawn salary means the year he retires, that time what will be salary, based on that he will get the gratuity amount. Okay. So here you will have to assume the increment of employee, which is assumed to be 10%. And we also need the completed years of service. That means for how many years he will work for the company, you have to assume it. So we assume it to be 5 years. Discounted 10% is given. What to do with this, we will study later on. So first you have to find the gratuity amount. How will I find it? 1% into, I want the final drawn salary. His today's salary is 10 lakhs. I don't want this. I want his salary after 5 years, because we are assuming that he will work for 5 years. How do I do it? So I have to add the increment of 10%. but how many years I will add the increment. So normally we say if we will work for 5 years, add the increment for 5 years, but no, you will add the increment only and only for four increments you will add. Why? If you work for 5 years, in 5 years you will get only 4 increments. How come, sir? Assume your articleship, you work for 3 years, but you only get 2 increments. Why? If your stipend is 3,000, 4,000, 5,000, how many increment did you get? From 3 to 4, 1 increment, from 4 to 5, second increment. So when you're working for 3 years, you get an increment of 2. That means when you're working for 5 years, you will get 4 increments. As simple as that. So we will do 1% into the salary after 4 increments into number of years of service. So you will get 73,205. This is the payment which the employee will make after 5 years. But can I say this payment will accrue to the employee over the period of 5 years? Because employee will earn this when he works for the company for 5 years. Okay. So this means this expense will be paid after 5 years. But it has to be booked over the period of 5 years. Little every year. How much will I book every year? So divide by 5. So this is the expense each year. Okay. So let's say expense accrues on the year end. So this 14,641 will first expense will accrue on the first year end. Okay. So we will have to book this. But the issue is this payment is going to be made after 5 years, after the 5th year end. So we will have to book this at present value only. Remember I taught you in PF, when you are making the payment after 12 months, book at present value. Here you are making the payment after a certain number of years, book at present value. But after how many years I am making the payment? If you count from year 1 end till year 5 end, it is not 5 years, it is 4 years. Because you are counting from year 1 end till year 5 end. So this amount is payable after 4 years. So discount it, you will get a present value 10,000. Now, what is the normal entry for expense? Because it is expense, company says expense, but because it is not being paid today, we will say payable. So we will say expense to payable, gratuity expense to gratuity payable. But now let's rename the terms. Instead of expense, I will say current service cost. Instead of payable, I will say defined benefit obligation. So the entry becomes current service cost to defined benefit obligation. I just renamed the terms, but the logic you got, it is expense to payable. 10,000 on year 1 end. Done. Then after 1 year, first unwind this amount. We know now we have to do unwinding because it was booked at present value. So unwind it. 10,000 into 10% unwinding. So you will say interest cost to DBO because of liability is increasing. So to DBO, and unwinding is known as interest. Normally interest gets transferred to finance cost, but in Ind AS 19, whatever interest is there on employee benefit expense, always transfer to employee benefit expense only. Okay. So in the second year we did unwinding. Then in the second year you have to do one more thing, book the expense also. Why? Because this 14,641 we have to book every year. So second year expense also we have to book now. Again you will book this as present value. This second year, if you count from second year, you have to pay this after 3 years. So book 11,000 now. Okay. So in second year we are doing two things. First unwinding of the first year amount and then booking the second year expense. Do remember, first do unwinding and then book the expense. Why? Because if you book the expense first, you might make the mistake of unwinding on both the expenditure. Ideally, the expense booked on second year. The unwinding of this expense will start in third year. Do remember. So just remember, in second year, first unwind the first year's amount and then book the expense. So similarly, we will do for third year, fourth year and fifth year also. So prepare two tables now. Why? Because the unwinding will also be tricky in the third year. So for unwinding also, I prepare a table now. Why? So I see in year 1, this was the expense booked. In year 2, opening was this much, unwinding was this much, expense booked was this much. In year 3, how much will I unwind? The closing of year 2 becomes the opening of year 3. Now unwinding on year 3 will happen on this amount, 22,000. So prepare a table. So two tables are prepared here. One to calculate the unwinding amount, and second this table, that expense which accrues today is payable after certain number of years, so book at present value. Okay, so I had solved this full example. You can just refer it. Of course, I have solved these examples assuming that the estimates hold true. Whatever estimates are given of 10% increment, number of years of service hold true. So we have solved the expense. In this example, we learned 3 terms. One is current service cost, second is defined benefit obligation, third is interest cost. What is current service cost? The expenditure of current year is current service cost. It goes in employee benefit expense, profit and loss. Second, what is defined benefit obligation? The payable amount for current year which is going to be paid in future. So that payable we create, that payable is defined benefit obligation shown on the balance sheet liability side. Third item is interest cost. It is nothing but what unwinding you do, that is interest cost. Okay, that interest goes again in employee benefit expense, profit and loss account. Okay, now I guess we all will agree that in this question there were so many assumptions. What if in after 1 or 2 years maybe there are changes in assumptions? Then what to do? Then whenever there are changes in your assumption or estimates, your two impacts can be there. either your DBO can increase or your DBO can decrease. Don't worry, because of change in estimates, you are not expected to calculate the amount. Amount will be given. You need to pass the entry. What entry will I pass? So if there are changes in estimates, just see whether DBO is increasing or DBO is decreasing. If DBO increases, that means liability is increasing. So credit the liability to increase it. Now, what will I debit? We will debit actuarial loss on DBO. Why loss? If liability increases, then loss for you now. Okay. Then if DBO decreases, debit the DBO, and if liability is decreasing, it is a gain for you. So credit to actual gain on DBO. Where will this actual gain loss be transferred? It will be transferred to OCI NR. Why OCI? Because estimates can change very frequently. So we are not impacting the profit and loss. We will like to transfer it to OCI. Now, in this question, if there are changes in estimates, we will adjust with the actual gain loss. What if there is a plan amendment? What is the meaning of amendment? Can I say this 1% was a certain figure, that whatever is a salary, we will give 1%. What if I change this? Whenever this 1% changes, which is a certain amount, whenever you change this is a plan amendment. Okay. So amendment can be increasing the 1% to 3% or reducing the 1% to 0.5%. This can be the amendment. Because of this amendment also, your DBO can increase or decrease. If DBO increases, then now you will call it a past service cost. So DBO increase the liability, debit the past service cost. Past service cost will be transferred to employee benefit expense, profit and loss. If DBO decreases, debit the DBO, credit the past service cost. Again, past service cost will be transferred to employee benefit expense, profit and loss. But because you are crediting an past service cost, in employee benefit expense, it will be shown as a negative. Why? Because you are showing on expense side. You are showing a income on the expense side. So show it like a negative figure. Okay, do remember. Now, why past service cost? When you amend the plan, it is very rare. That is why we are impacting our PNL. Do remember. Here, we are not using the word actual gain loss. Instead, we are using the word past service cost. Why? Because it is an amendment. So how to differentiate an exam? Do remember, if there are changes in estimates, then it is actual gain loss. If there is a plan amendment, then it is a past service cost. Okay. Plan amendment is rare. Therefore, you can impact profit and loss. This estimate change are very frequent. So impact OCI NR. So 5 terms done. Current service cost, DBO, interest cost, actual gain loss, and then past service cost. Now we have to make such a huge payment of gratuity after 5 years. So student, we start saving for this today itself. So when you save the funds for making the payment in future, that is known as plan assets. Okay. So what is plan asset? Investment done exclusively to fund the DBO. Okay. So whenever you contribute in the plan asset, entry will be plan asset to cash bank. Okay. Do remember, it is not necessary that your DBO and plan asset amount will match. It can be different. Why? If in case in current year you have more funds, you will save more. If you have less funds, you will save less. Okay. Do remember. Then when you invest in a plan asset, of course, you will have certain expectation of earning some return also, right? So that is known as expected return on plan asset. What will be your expected return? The discount rate which you use to unwind the DBO, that exact rate will be your expected return. When I say expected, I am saying that this is the expectation which you enter with. Your actual return can differ. It can be more, it can be less. But whenever I invest, I will always expect that I have to earn this much return. How much percentage? The exact rate which you used for unwinding the defined benefit obligation. Okay. And whenever you earn expected return, you will reinvest it. Okay. So entry will be plan asset account debit to interest income. Why income? Because it is earning on assets, so income, and because you are reinvesting, it will be plan asset. Okay. Then next point is actuarial gain and losses on plan asset. What is the meaning of this? Whatever return you earn over and above your expected return. Let's say my expectation was I will earn 1 lakhs, but is it possible I earned 3 lakhs? So how much excess did I earn? I earned excess of 2 lakhs because instead of 1, I earned 3. So excess, how much did I earn? 2 lakhs. That excess earned on plan asset is actuarial gain loss on plan asset. So if you earn over and above expected, actuarial gain on plan asset. If you earn less than expected, actuarial loss on plan asset. Okay. So it is given here. So how do we find this? When you do plan asset plus expected plus contribution plus if you withdraw something, you will get a certain amount. Closing figure will be given. Your this amount and this closing will not match. So just see, if your asset is increasing, then you have earned more than expected. If your asset is decreasing, you have earned less than expected. Simple. So that means Can I say there are two types of return on plan asset? One is expected return and one is actuarial gain and loss on plan asset. Okay. The combination of these two is your actual return. Okay. Expected return plus over and above your expected return, that is actuarial gain and losses on plan asset, is your actual return on plan asset. Don't get confused between the word actuarial gain on plan asset and actual return on plan asset. These two are different. Expectation plus actuarial gain on plan asset is your actual return. Okay. This expected return is getting transferred to employee benefit expense, profit and loss. This actuarial gain and losses is getting transferred to OCI NR. Okay. The combination of these two is your actual return. Do remember, actual return, you need not book it separately again. Why? Because it is a combination of two amounts and these two amounts have already been booked in the respective columns. Okay. So again, three more terms are introduced. Plan asset goes in balance sheet asset side. Second, expected return on plan asset, that is the interest income which you expect to earn, goes on employee benefit expense, profit and loss. Third is actuarial gain and loss on plan asset, the income which you earn over and above your plan asset, over and above your expected return on plan asset, that is actuarial gain and losses. This will go in OCI NR. Okay. And the combination of expected return and actual gain and loss is your actual return. Okay. The next point, curtailment and settlement. What is the meaning of this? Ideally, curtailment means cancellation of plan. That means you cancelled a specific plan. So liability is over. So just reverse the liability and book the gain on curtailment, or you can also use past service cost. For this, liability will reduce and this past service cost will go in employee benefit expense, profit and loss account. Acha. There is one more term, settlement. Settlement happens when you are settling for a lower amount. So let's say DBO worth 1 lakh was settled for 90,000. Here you have to do two things. First, because you have to settle for 90,000, you have to make the payment of 90,000, withdraw the money from plan asset. So you will say cash bank to plan asset 9090, and then you will settle the DBO. When you are settling the DBO, do remember you are settling a DBO worth 1 lakh. So liability will get reversed worth 1 lakhs, but payment you will make only of 90,000. So balance will be gain on settlement, or you can also use past service cost. Okay. Ideally the meaning of both these terms is different. Curtailment means cancellation completely, no settlement payment. In settlement, we cancel a higher liability with a lower amount. But ICI uses these terms interchangeably. So do remember, normally this comes in exam when you settle for a lower amount. Okay, do remember. Then 9 terms are clear. Okay, current service cost, DBO, interest cost, then actuarial gain on DBO, then it was past service cost, then plan asset, then expected return on plan asset, then actuarial gain and loss on plan asset, then curtailment, settlement. 9 terms done. Now remaining terms are very simple. Then the term is net defined benefit asset liability. The plan asset of asset side and the DBO of liability side in balance sheet are netted off and shown. Next, net interest expense and income. One, there is interest expense which is arise due to unwinding of DBO. One is interest income which is expected return on plan asset. These two will be shown as net off figure in employee benefit expense. Then one, this I will discuss later. Then there is remeasurement gain loss. Whatever items appear in OCI, two items as of now appear in OCI. Actuarial gain loss on DBO and actual gain loss on plan asset. These two items are netted off and known as remeasurement gain loss, which will come in OCI. Okay. Now there is last term, asset ceiling. What is the meaning of asset ceiling? So this is applicable only when there is a net defined benefit asset. When you net off the asset and liability, in net there is an asset, this concept is applicable. What is this concept all about? The name itself says there is a asset ceiling, means there is a capping on the asset amount, right? So if your net asset is coming at 30, but the asset ceiling amount is given as 20. Now why it is there? We have already discussed in the class. Now I'm focusing on revision. Okay. So here, if the asset ceiling is given as 20, that means your asset can't be at 30. Maximum it can be up to 20 rupees only. So the excess 10 asset, you will have to reverse it. Just remember, ceiling means this is the maximum asset which you can show. So even if your net asset is coming to 30, doesn't matter. You will have to restrict it to 20 rupees. So you'll have to reduce the asset by rupees 10. That reduction is a loss due to asset ceiling. So how will I book it? This reduction will also gain OCI. So I will say OCI NR 2, plan asset or net defined benefit asset. I will credit the asset because I have to reduce it. 10 rupees, 10 rupees. Do remember that. Okay, this will also gain OCI NR. So in OCI NR now there are 3 things. One is actual gain loss on DBO, one is actual gain loss on plan asset, and one is decrease in asset due to asset ceiling. Okay. Acha, do remember this asset ceiling is only applicable when there is a net defined benefit asset. In case if there is a net defined benefit liability, it is not applicable. Second, if the net defined benefit asset is 15 and the asset ceiling is 20, no problem, because your net asset is already within the limits of asset ceiling. Don't increase, don't increase it. we will keep at 15 only. The issue is when this is higher than asset ceiling, then we have to reduce it. Okay, chalo. So this was your retirement benefits, and in that we discussed about defined benefit plan. Okay, so if you want, you can see it here. Defined benefit plan is over. Now apart from this, I have given the summary also. In your notes you will find a summary also, how will everything appear in profit and loss, in OCI and everything. Okay, apart from this there are two more concepts, that is other long term benefits and termination benefits. Let's discuss this also. Other long term benefits means any other long term benefit apart from retirement benefits. Okay, so long term means any benefits which are settled after 12 months, but apart from retirement benefits. Now how to account for this? So it says the accounting is same as defined benefit plan. Defined benefit means that current service cost, past service cost, DBO, that same accounting is there. Only one difference is there. Here the remeasurement gain loss will not be transferred to OCI, it will be transferred to PNL. It can be relevant for MCQ, do remember that. Okay, sir, give us example of other long term benefits. Sabbatical leaves. Okay, example, if you want to study, your company is saying go do MBA for 3 years, that can come here. Okay, so accounting is same, but except all the OCI items, there is no concept of OCI here. Transfer it to PNL only. Sir, why PNL? Because the uncertainty involved here is very less compared to defined benefit plan. Sir, do we have any questions on this? The answer is no. No question on this. Then there were termination benefits. How do I solve termination benefits? So if you want, you can refer the notes, where I will show it to you. What is the meaning of termination benefits? By the way, termination means when you are terminating, when you are closing a division, you will terminate the employees. So if you are going to make any payment to those laid off employees, that is termination benefits. Can be of two types, VRS or retrenchment scheme. Okay, so these are payable on account of termination. So whenever you terminate, and if you promise to make any termination benefits payment, then only you will book the liability or expense or whatever it is. Okay, so we will book an expense and liability only when constructive obligation arises. When does it arise? When you announce the termination and when you promise a compensation. Let's say if you did not promise anything to pay on termination, then nothing will come. When you promise, obligation comes upon you, so you will have to make the payment. Now there can be of three types. One, if you have paid immediately, then expense to cash bank. Second, if you have promised it today, but you are going to make a payment within 12 months, maybe in the next year, so book the expense today, and whenever you pay, reverse the payable and say to cash bank. But third case can also be there. When you promise it today, but you are going to make the payment after 12 months, in this case, book at present value. So expense to payable at present value, then do the unwinding and then make the payment. Simple, logical now it is becoming very logical, right? On this note, we have completed all the conceptual part of IND AS 19, right? Now we will move up towards certain questions. See, if I tell you now in IND AS 19, of course you should go through all the questions. I will take up the more important ones in this part, but do remember, if you want to have a focus area, two focus areas are there. One is the questions based on leave compensation, and the remaining based on defined benefit plan. These two I feel are the more areas to be focused on. Okay, now let's start doing the questions. So question number 2 and question number 3, you can just give it a read, it is very simple. Then let's come towards question number 5 also, just give a read. 5 I'll tell you. Normally what is given here, we have 100 employees, okay, who have 2 days of unused leaves. Okay, so normally we create an expense and liability in the current year, but they can be two types, vested or non-vested. Do remember, when it is written vested, you will create the expense and liability on the full leaves, that is 100 employees into 2 days. But when it is non-vested, also consider company's expectation. Your company expects that only 20% employees will avail 1 day. So you will consider the expectation in case of non-vested. So in non-vested, if it was non-vested, you will say 100 employees into 20% into 1 day only. Do remember. So if it is vested, because vested means encashable, so in encashable you will not consider expectation. Why? If employee has a leave, he will encash it for sure. But in non-vested, you will consider company's expectation. Do remember. Then there is illustration number 6, a very good question. Please, you have to solve this, but we will discuss it together. What is there? There is a staff attrition rate. There are 350 employees. Then staff attrition is given at how much? 6%. That means every year 6% employees will leave. But here there is an assumption that when certain employees leave, they will be replaced by new employees. Okay. Then 10 days is given on paid vacation. Okay. Every employee has 3 days unused. Okay. In the current year. In the previous year. Average salary per day was 15,000 in the previous year. Okay. During 11-12 next year, employees took 9 days vacation. Salary increase was 10%. Recognize the expense and liability. So, see here how to solve this question. Wait, illustration number 6 here. See, so we have 350 employees. Okay, So these for old employees, how many old employees will be there in the next year? Only 94% because 6% will leave. So these old employees will have a 3 days opening balance. In current year, they will earn further 10 leaves. In totality, they are 13 days now, but they avail 9 days. How much balance is left? 4 leaves per employee is left. Now, multiply it by number of employees. So these are the total leaves. Okay. Then for 6% who left, we have assumed that they have been replaced by new employees. So new employees 6%. Now because these are new employees in the current year, they will not have any opening balance of leave. So it will be nil. They earned in the current year 10 days, they avail 9 days. One leave will be there. So total leaves here are 21 employees. 21, how did you get 21? 350 into 6%. 21 into 1, 21 leaves you get. Okay. So total leaves, how much you have? 1316 plus 21. Total leaves you have 1337. Multiply this by salary per day. Now salary of previous year was 15,000 per day, but 10% increment is there. Of course, we are assuming that even the new employees get the incremented value. Okay, salary per day is 16,500. So company books a total expense and provision of this amount. Okay. Why expense and provision? Because the employees have this much leave balance in the current year, book the expense and provision in the current year. Simple. Also, provision was given of previous year. We have reversed it and paid it off. Okay. Provision to cash bank. I have given the logic why it has been paid off. Okay. Do remember that. So this was illustration number 6, which we did. It is a very good question. Please solve and go. Okay. Apart from that, this small question, just give it a read. Okay. Don't leave anything. Just give it a read everything. But of course, I will focus more on the question which are important here. Now, illustration number 24. What is given here? It is said that RK is an old company. Company started with a very small capital. Okay. We have the following balances of the funds. We have opening balance given DBO 1400 and plan asset 1140. Okay. So opening balance is given. So how to solve these type of questions, I will tell you. So there is a very basic formatting which is involved here. Prepare 3 columns. One is DBO, one is plan asset, and one is net column. Okay. So likewise I prepared here. One is the DBO column, plan asset column, net column. Okay. So opening DBO was given, PA was given, and net I wrote. Net, I guess liability is higher, so net it will be shown as liability. Then first of all, on the opening balance, always accrue the interest. On DBO, unwinding will be done. On PA, you will earn expected return. We did that. Okay. Then current service cost was given. What was the entry for current service cost? It is current service cost to DBO. So only DBO will be impacted. So add in DBO. Then you made a contribution of 111 lakhs. So what will you do? You will add the contribution on plan asset. Okay. Then, but you have been given the closing. Of course, your this and closing is not matching. There is some difference coming. Why is that difference? In DBO, the difference will be because of actual gain loss, and in plan asset, it will again be because of actual gain loss. Now, whether gain on loss, see, if liability is increasing, it is a loss. If asset is decreasing, it is a loss. If asset increases, it is a gain. So just apply your basic logic. Now, what was asked? They have asked the extract of balance sheet. So what will be shown in the balance sheet? The closing balance at net figure will be shown in the balance sheet. Preparing the net column is also important. Now do practice it. Okay. So closing balance will come in the balance sheet. I will show at 305. Then P&L extracts are also asked. In P&L, interest will come at net. So net, this is the interest. In P&L, current service cost will also come. These 2 items will come. So I wrote these 2 items. Then this actual loss, on both I have loss only. So this 2 will come in OCI. So I showed it at OCI. Simple. One more thing was asked. Entries were asked. So to make you explain this, I passed the entries individually, but I see I have passed a combined entry. How did I pass the combined entry? Just look at the extract. Book the total P&L expense together. Book the total OCI loss together. Okay. Then liability increased from 260 to 305. Okay. So book the increase in liability, and then contribution you made of 111. So book the contribution. That is how it is done by ICA, but I have, for understanding purpose, given the individual entries also. You can refer it. Board notes, again I'm telling, I will upload on my Telegram. You can join it. Okay. Then this was question number 24. Then we do illustration number 29. Again, a very good question. It has 3 concepts covered here. First concept is certain employees were there who had certain leaves. What to do? So for the leaves they earned in the current year which are unutilized, company will book expense and provision. So 200 employees have this much leave balance. 800 employees have this much leave balance. Whatever is the leaves, calculate it and tell that current year company will book expense and provision on these leaves. But the issue is per day salary is not given here. So you can just calculate the leaves. So I have calculated the leaves in the solution. Then it is said that employee has also promised a bonus of 4% at profit. But the issue is company expects to pay only 3.5%. Expectation will be considered. So 2000 into 3.5%. Company will book the expense. If it has been paid, then to cash bank. If not yet paid, then expense to payable. Acha, here. Then third part is defined contribution. Remember contribution plan. So here the expense has accrued at 100 CR, but company has made a payment of only 20 CR. So what will be the entry? Your expense will be 100 CR, but you have paid only 20 CR. So balance will be payable 80 CR. This is payable under which plan? Under defined contribution plan. So defined contribution plan is very simple. Expense will be given, book the expense, payment will be done, balance is payable. Simple. This was illustration number 29. Then the next important question, and the most important question, is illustration number 32. This question will cover all your bases. So just see very quickly what is there. So DBO is given and plan asset is given, opening balance is given. So what do? I write the opening balances first. I will show the solution to you as well. Wait. Here it is. So what I will do, I will write the opening balances first. Net column, just practice it again. Okay, net liability is higher. Very good. Then on the opening balance, always compute the interest part first. Okay, so I did the interest calculation on the both the opening balances. In DBO, it is unbinding. In plan, it is expected return. Then what is given? Then it is given that we made contribution of 70 lakhs. Contribution are done in plan asset. So our plan asset will increase. So my plan asset will increase. DBO will not be impacted. Do remember. Then it is said that benefits of 42 lakhs are paid out. When benefits are paid out, DBO and PA both will be impacted. Why? When you pay out benefits, you will withdraw the money, and when are you paying, liability will also reduce. So plan asset reduced, liability also reduced. Okay, for your reference, I have also given the entries just for understanding in case you are not able to crack this. Okay, then it is said that current service cost is given. Where will it be impacted? In my DBO. So current service cost, DBO increases. Okay, then also what is given? Then past service cost is given. Why? Because the plan has been amended. Because of amendment, past service cost comes 15 lakhs. Again, DBO will be impacted 15 lakhs. Where is it? Here it is, past service cost. Then in this paragraph, it is talking about settlement. Settlement, I will just give the summary of it. One sec. Here it is. So next paragraph talks about settlement. Settlement of DBO of 80 lakhs. They were settled for 75 lakhs only. So when I settle for 75 lakhs, how much money will I withdraw? I will withdraw only 75 lakhs. So I withdrew 75 lakhs. Okay, and then I made a payment of 80 lakhs. So my DBO will go down by 80 lakhs. Do remember. Acha, net column is also very important. I will discuss for this question as well. My opening DBO 6 CR, PA was 5.2 CR, liability is higher by 80 lakhs. Then interest expense is 30 lakhs, interest income is 26. So net expense is 4 lakhs. This will increase my liability. Then contribution is done in asset. So when you contribute in asset, can I say my liability reduces? So the impact on net liability will be negative. Then you withdraw. PA and DBO both go down by 42 lakhs. No impact, net no impact, because asset liability both are reducing by the same amount. Current service cost increases my DBO, so add in net liability. Past service cost increases my DBO, add in net liability. Settlement, asset going down by 75, liability going down by 80. So can I say liability is going down by 5 lakhs more? Yes. Then your closing won't match with the closing given in the solution. The difference will be, because liability is increasing, it will be actual loss. And if you see the asset, it is also increasing. So if asset increases, it is a gain. So actual gain. Okay. In this question also, extract was asked. So extract has been given by me. In balance sheet, net will come. In profit and loss, net interest expense, current service cost, past service cost, and also you have settled for less amount. This gain on settlement will also come here. Okay. In OCI, remeasurement loss, net will be shown here. Okay, so this was a very good question. Presentation has been given by me, just refer it. 33 is same like 32, just refer it, it is very similar. Then we come to question number 2 of MTP RTP past paper. What is this question all about? This question has only one important calculation. I will tell you which is it. So it says we have a opening balance of plan asset of 10 lakhs. Okay, opening balance of DBO is not given. Okay, anyways, we paid out benefit of 1,90,000 and contributed 4,90,000 on 30th September. Now the issue was, in all the above questions, we calculated interest only on this 10 lakhs on the opening balance. Okay, because in all the above question, we used to assume that contribution and benefit were paid at the year end. So no interest impact used to come on that. But it is clearly said that now the benefits you paid of 1,90,000 and the contribution you made of 4,90,000 is happening on 30th September. So how much is my net contribution? I contributed 4.9, withdraw 1.9. So net contribution is 3 lakhs. Now assume if you are investing your 3 lakhs in a fixed deposit on 30th September, will you get interest for 6 months on this deposit? The answer is yes. That means interest will now come on two amounts. 10 lakhs for full 12 months. 3 lakhs only for 6 months. Why 3 lakhs? Net contribution. That is why. Okay. Now one more point is important here. Here the compounding happens half yearly. That means the rate which will be applicable to 6-month interest will not be the same as 12-month interest. Because if you are receiving 12-month interest on any figure, you will receive it in a compounded manner, right? So two rates have been given here. One, if you receive a interest for 6 months, so normal interest rate for 6 months is 10% per annum. But if you receive a interest for a 12-month, you will receive at 10.25% per annum. So when doing the calculation, just remember this simple thing that I will show you. Here it is. Opening balance you write, net contribution you benefits 1.9, contribution 4.9, net contribution 3 lakhs. While calculating expected return on opening balance, take 10.25% per annum. Why? Because interest, if you are getting for 12 months, rate relevant is 10.25%. Okay, and when you are getting interest for 6 months, take 10% per annum rate. But because this rate is per annum, do 6 by 12. Okay, do remember that this calculation is important. Through this you will get expected return. Okay, so this was your opening balance, less the benefits, add the contribution, add the expected return, you get the closing balance. DBO you can't do, also it is not required to be done. I'll tell you why. Okay, then you find the balancing figure as actual gain on plan asset. Now what is asked here? They have asked first actual return. Oh my god, they have asked actual return. What is actual return? Expected return plus actuarial gain on plan asset, right? So my expected return on plan asset and actual gain on plan asset is my expected return, is my actual return. Got this? Then what is asked? Then they have also asked expected return. Expected we already computed now. That was the important calculation here. Done already. Here it is. Then they want also compute amount to be recognized in OCI. In OCI, what amount will go? Can I say this actuarial gain on PA will go in OCI? Also for DBO, they are so nice. The actuarial loss on DBO is already given in the question. So in OCI, this loss will be there. And apart from this, there will be gain of plan asset, right? So that net off you will show in OCI. Okay, yes. So this was question number 2, and with that we have completed the revision of IND AS 19 employee benefits. I really hope that this revision was helpful. Have tried to revise all the concepts along with the important questions in detail. I've tried to discuss it. Of course, to remember, watching the revision is not a replacement of your writing practice. Once you watch the revision, the concepts which you are able to recall, very good. No need to refer again. The concept which you did not recall, mark it, refer it again, and directly jump on towards the questions. The questions which I told you, write and practice. Other questions, just refer it once. If you find anything interesting in that, just mark it for your next reference. This should be the approach. I have given you a approach worth lakh rupees, you can say, because when you become a CA, you will earn in lakhs. So approach worth lakh rupees. Okay, so on that note, thank you so much everyone. If you like the video, do like it, and if you find it helpful, do leave a comment. That will motivate me and that will help me come to know whether this was useful or not. If it is useful, I will try to upload more such revision videos only for my lovely South India students in 100% English as well. So thank you so much. Bye bye everyone. Take care. See you all.